lowest down payment isn't necessarily the cheapest one, and the loan everyone assumes is only for first-time buyers actually isn't. Conventional, FHA, VA, USDA, and jumbo. I'm Helen Reed, a realtor with eXp Realty serving Sacramento and Placer County, and these come up with buyers all the time. So today, I'm breaking them down, what actually separates them, and who each one tends to make sense for. Let's start with conventional loans since they're the most common. Conventional loans aren't backed by a government agency, and they generally work best for buyers with a stronger credit and a solid financial profile. You can put down as little as 3% in some cases. Under 20% down, you'll typically have to carry private mortgage insurance, or PMI. Here's the difference that matters. Conventional PMI can eventually go away once you meet the requirements. That's not true of every loan type. You'll also hear conventional loans called non-conforming or conforming. Conforming simply means the loan amount falls within that year's county loan limit. Once you're above that limit, you're looking at a jumbo financing. We'll come back to that. So next is FHA. FHA has a reputation as the first-time buyer loan, but you don't have to be a first-time buyer to use one. What it really offers is flexibility in qualifying, lower credit scores, smaller down payments, or higher debt-to-income ratios than conventional. The trade-off is mortgage insurance. FHA loans carry both an upfront premium and an annual premium, and that's usually paid monthly. And that annual premium can remain for a long time, and in some cases, for the life of the loan. Right now, the FHA loan limit for Sacramento and Placer County sits around $764,000. That number resets every year, so always confirm exactly where it stands with your lender before you shop. Now, VA loans. If you're eligible, this is one of the strongest products out there. Qualified borrowers can buy with zero down. There's no monthly mortgage insurance, and rates often are very competitive compared with conventional loans. There's also a benefit that doesn't get nearly enough attention. VA loans are assumable. FHA and USDA loans can be assumed too. That means a future buyer may be able to take over your loan, including your interest rate, when you eventually sell. If rates are higher at that point, that can make your home significantly more attractive to buyers. There's usually a funding fee at closing, though some borrowers are exempt, depending on service history. So this is one where you want a lender to run your specific numbers rather than assume. Then there's USDA. And no, you don't have to buy a farm. I know the word agriculture is right there in the name, but USDA eligibility is based on geographic boundaries, not land use. And plenty of eligible areas around here look completely suburban. USDA can offer true zero down payment financing, but there are two sides to qualifying. You have to qualify, and the property has to qualify. There are also household income limits based on the area, so it isn't available to everyone. If you're looking outside the more urban parts of the region, it's worth checking the eligibility map before rolling it out. And finally, jumbo loans. This is the one people misunderstand the most. Jumbo isn't about the price of the home. It's about the loan amount compared to the conforming limit for the county. Someone buying a more expensive home with a big down payment might still land in conforming territory, while someone putting less down could easily cross into jumbo at a much lower price point. Jumbo loans tend to come with stricter underwriting, larger down payment requirements, and lenders often want to see cash reserves left after closing. The last part catches people off guard, because you can have enough for your down payment and closing costs and still not qualify if reserves are short. Some lenders offer a piggyback structure instead, using a first and then second mortgage together, which can be worth exploring depending on the numbers and your lender's guidelines. So, which loan is right for you? There isn't one best mortgage. There's the mortgage that best fits your situation based on your credit, your savings, and any military eligibility, and the home you're buying, and your long-term plans. Two buyers could purchase the exact same house on the exact same street and walk away with completely different loans, and both could be making the right call. I've got a full breakdown on my blog with a side-by-side comparison in current 2026 loan limits for Sacramento and Placer County. I'll link it below. And if you're not sure where to start, reach out. I can connect you with a lender that I trust, and I'll tell you exactly what I'd tell a friend in the same situation.